Good afternoon. Welcome to our weekly High Rock video where we're going to talk about the global economy, about the financial markets, and the world of wealth management and how all that affects what we're doing in our client portfolios. I'm Scott Tomlinson. I'm joined by my partner and colleague, Paul Tepsich, the founder of High Rock. And if you are a first-time listener, there is a website you can visit, www.highrockcapital.ca. And you can find out all about us there. Okay, so let's start. We're going to start talking about a little bit with regard to our models. We believe that traditional correlations between stocks and bonds are no longer enough to completely reduce risk. So we have turned to a more tactical style of portfolio management. And I'm going to invite Paul now to talk about what we've been doing over the course of the last week.
So on this slide, we'll typically talk about changes on the week, any changes we've done in our models. So one fairly major change is we did sell, maybe mid last week, we sold our entire weight in 10-year Government of Canada bonds. And part of that was related because we want to move into a more current bond, but also because, as Scott just mentioned, correlations between stocks and government bonds has been falling apart a little bit here over the past couple of weeks and continues today. So we will rebuy those bonds, and I've got a target in mind, but we're going to try and wait and be patient. No changes in the global equity model. In the tactical model, we did a couple changes last week. We initiated a new position in a stock that is in our opinion, a low-risk way to play cobalt. And as people may know, cobalt is a element mined as a byproduct. You don't actually mine for cobalt. It's a byproduct of copper and nickel. So we are invested in a nickel-producing company. We think they will monetize part of their cobalt stream shortly. So we own bonds in this company, and now we own a small weight in the stock, and I wouldn't mind adding to it, to the stock, that is, but I'm trying to be patient with it. The other change we had in the tactical model is we've been trading one of our core energy bonds, an oil bond, Baytex stock, which we've talked about before. So we continue with the core weight, but we have been trading it around, knock on wood, somewhat successfully for the past month or so. So we continue doing that.
And just in regard to our global equity model, like once again, as our clients know, we think equity markets are pretty well overvalued. A lot of the good news is built in, and maybe a little bit more today since the U.S. passed their tax reform. But
they haven't passed it yet.
True enough.
They still have to reconcile between the House and the Senate, and there are differences. So it's on its way, but not passed yet.
Good point. And it's still out there as to what the end impact will be. There's still lots of uncertainties regarding that. So at this juncture, even though stocks are moving a little bit higher, we're still remaining cautious. And Goldman Sachs came out last week with a report that suggests that valuations in both stocks and bonds were the highest since 1900. And again, another reason why the protection that one might get from bonds is not as strong as it might have been in traditional times.
Right.
Another part of seeing the U.S. equity market stronger, and something that we've been following for a while, and certainly last summer we saw the actual gap between economic growth and equity market prices widen as economic data came out and was somewhat weaker than expected. But lately, we've actually seen stronger than expected U.S. economic data, and it's actually started to narrow that gap again. So the one wild card out there, I think, still are the geopolitical risks. Do you have anything to comment about that? I mean, obviously, we saw North Korea launch a missile last week. What about the Middle East?
I think there's going to be a war in Iran. And that's part of the reason why we added to our oil weight in some stocks and bonds. I think that's a big risk. I think North Korea obviously is risk. I don't know how real any of those are, but I think they have a certain probability of actually occurring. And then there are other political risks, not sort of war related, but as you mentioned, the tax reform going through, and also we've got Brexit, which is being negotiated and just came out this morning. It doesn't sound like it's actually moving so far forward. And in Canada, we've got NAFTA as well. So there are some just more benign political risks, but they will affect markets and currencies and bonds.
Sure, and in the United States, there's become a bit of a battle between the FBI and the President of the United States. So
yeah.
that throws some more what we would classify as geopolitical risk into the mix.
Mm-hmm.
Last week in Canada, the big news from an economic perspective was the employment data. We've seen, and if you look at the chart that we're going to pop up here, the month-to-month data can be quite erratic, but it was a big jump in the Canadian employment numbers. We look at the longer-term averages, or the what we use as a 12-month moving average to smooth out those erratic moves on a month-to-month basis, and we can still see it has been a slow grind higher as far as employment data are concerned in Canada. What do you think? Is that enough to bring the Bank of Canada back to the?
That's a good question. I think they meet on Wednesday.
Yes, they do.
I believe Wednesday morning at 10 a.m. we'll get the report on whether they raise interest rates or not, and that's what Scott is asking. That's a good question. I still think the quality of employment gains are, and I'm reading a report right now from the former governor, David Dodge, at the Bank of Canada, and there still appears to be slack in the economy. Two things I think that concern central bankers are: why is inflation not moving higher with all these employment gains? And B, these employment gains maybe are not of very good quality. And what I mean by that is they are largely part-time employment gains and lower paying jobs. So they're not as good a quality as if they were in the high-tech space and higher paying jobs, higher trained employees. So we'll have to watch and see. I don't know. I still think the bank is concerned about the Canadian dollar having rallied so much. And although it's given up some gains over the past 3 or 4 months, it did rally a fair bit on Friday after that report, and our bond yields went higher. So that was a natural reaction.
And that, in and of itself, was not a bad situation for us, having sold those 10-year bonds.
Yeah, that worked out well.
Yeah,
we did give back some on the Canadian dollar, to be fair,
but that's a longer term situation
absolutely.
For sure.
Absolutely.
And in fact, a fair bit of that Canadian dollar bounce higher was fairly knee-jerk because foreign exchange markets doing what they do, try to build in the next Bank of Canada moves right away when they see news like that. So we did see that strength in the Canadian dollar on the back of that. Mm-hmm. Speaking of the Bank of Canada, last week also the Bank of Canada came out with their financial system review. And of course, it's something that we have to pay close attention to because they are talking about a lot of what we would consider to be the vulnerabilities and the risks in the financial system in Canada. They do gauge where we are relative to what they would consider moderate risk or elevated risk. Key situations being household indebtedness, and we've talked about that before. Debt in households growing faster than their income levels, so that debt as a function of disposable income continues to rise. We haven't seen the third quarter data. We won't see that till sometime next week, but nonetheless, it's still one of those vulnerabilities the Bank of Canada is keeping an eye on. Imbalances in the housing market.
Yep.
You've done a fair bit of your own work on the Toronto real estate market.
Yep.
Any comments on what you're seeing there?
I think that combined with the household debt level is a wicked recipe for potential disaster here if interest rates start going higher. But clearly the bank is aware of this, right?
Yeah.
So, I mean, I'm more concerned about policy initiatives from various levels of government on the housing market. So we've got B20 coming in Jan 1st. B20 is the new mortgage rule put in by the Office of Superintendent of Financial Institutions, OFSFI. That could have an effect. So I'm more worried about policy from levels of government and regulators than I am about rates going higher from the bank. They seem to be aware.
And another of the vulnerable points is the cyber threats. We know that our regulators have stepped up, making sure that we're as covered as we possibly can be.
Yeah.
But we know that, and we've seen on a global scale the problems. One other one that we want to point out is certainly with lower interest rates and lower general returns, investors are taking greater amounts of risk, and that's something that popped out at me in this situation. And certainly that's something that we care about from our perspective is when we're looking after our clients' money. Move that on forward. Other key risks. This slide is pretty busy, but really just the key looking at this particular slide is on the right-hand side where each of these respective risks are relative. So moderate, elevated, or are they elevated and decreasing, or are they elevated and increasing, or whatever the story is there. But the Bank of Canada monitors this, of course. It's great research, and for us, important for our clients. Any further comments on that?
No, I haven't been through the entire NPR, but we'll see what they do on Wednesday. My bet would be they don't raise rates. That would be my bet.
I would have to
Yeah.
second that. Mind you, we're not gamblers here. We don't bet. So, but our thoughts would be such.
We had a gun to our head.
Anyway, that's all we have to say for this week. Thank you so much for tuning in, and as always, we appreciate your feedback and any questions that you want us to answer on this video. Please don't hesitate to send us an email, and there are email addresses for you. But on behalf of all of us here, or the two of us here, have a great week. Bye.
There you go.